Hello, hello, hello. Welcome, everybody, to episode 5. Excited to continue this podcast with the Retirement Insights podcast with Jim Musgrave. I'm James Anderson, and I'm joined by our host, Jim Musgrave, financial expert with over 2 decades of experience. And today, a special guest, Andy Robertson, who's an expert in retirement planning industry. Today's episode is a must listen if you're pondering who should steer your financial ship into retirement. There's so many different types of financial advisors out there, and today we want to unravel the confusion and help provide some insights to you guys. So, Jim, Andy, you guys ready to get started?
Yeah, we are. And hey, thanks for the intro, James. I want to give you some context why I have Andy on the show today. So back in 2018, I started to do Social Security seminars, and in order to do a Social Security seminar, you actually have to be trained and go through a course and pass a test and all that kind of stuff to be qualified to teach the Social Security course. And so when I took it, basically Andy's company is the company that creates the class material that we advisors study to become competent in that. And anyway, I'll just, and if you just want to tell me just a little, tell our audience a little bit about what you do, and also, you know, how you get your business and talk to different advisors out in the country.
Sure. Well, thanks for having me on, guys, and happy to talk about the Corporation for Social Security Claiming Strategies. Our focus is we work with financial advisors across the country who want to specialize in retirement income planning. It's really difficult to be a specialist in retirement income planning and not include Social Security as part of that process. So for all your listeners out there, Social Security is far more complex than people realize. Nearly 3,000 filing rules, 500 plus possible filing combinations. And a really effective Social Security strategy, as Jim, you well know, not only will provide you with a better, more kind of successful retirement outcome from an income perspective, but it'll provide tax efficiency. It'll provide stronger income for any surviving spouse. It's really, Social Security is arguably the most important retirement income planning tool in the retirement income planning toolbox. And our focus as a company is to enlighten advisors on how they can bring Social Security into the process and make it a building block of a solid retirement income plan.
So, Andy, you go out. So, I just want to make sure I understand. You get invited by various companies to come out and talk to their advisors. Can you tell us a little bit about that and the types of firms that you talk with?
Yeah, so we are invited by pretty much every size firm in the industry, from the largest independent broker dealers and wirehouse firms to the smallest financial institution, to come out and educate their financial advisors on the intricacies of Social Security. So really what we do is we open advisors' eyes across the industry to the impact that Social Security can have in what in many instances is save an otherwise doomed retirement income plan. If you're a financial advisor and you're overlooking Social Security, you're really not bringing all there is to bear to the retirement income planning process. So what we've found is financial advisory firms recognize this is something that their folks need to hear about, and they put us in front of them, and we offer them a 14 chapter, 200-page textbook just on the retirement system alone, and obviously the software that I know you use regularly in your practice.
So when you go out and talk to these various firms, I mean, they could be, and we're going to go into different types of firms in just a minute, but there's firms that are more focused on investments, then there's more holistic type of comprehensive firms. But what are the different types of firms that you've seen out there, and what their focuses are, Andy? Because not everybody specializes in retirement planning. I mean, you know, this is a broad topic. When you call yourself a financial advisor, it's like calling yourself a doctor. You can specialize in all these different areas. So, you know, what are the different types of I guess, kind of advisors that you typically see when you're out, you know, talking to them out in different parts of the country?
Yeah, it's a great point you raised, Jim. I would say probably the vast majority of financial advisors, I would suggest somewhere in the neighborhood of 90%. I would classify them as generalists. You know, they're trying to be everything to everybody. And those really aren't the financial advisors that we work with, because they're not ready, you know, to dig into the intricacies of Social Security and recognize the value it can bring to the plan. So the firms are always trying to enlighten their advisors, but ultimately it's up to the individual advisor to decide what kind of planner do they want to be. Are they going to be a journalist or a specialist? And there are, as you say, there's different types of firms that are really focused on different approaches. So Broker dealers, for instance, are going to focus on mutual funds and other packaged products, where RIA firms are going to focus on building individual portfolios for their clients. But at the end of the day, by and large, what I see is most financial advisors are generalists, and their approach to delivering retirement income is very general. They have a tendency to focus on tools that are really growth first, income second. And as a result, they find themselves having to generate, I shouldn't say generate, their clients need to accumulate significantly more capital to do the same job that a specialist can do. A specialist typically can deliver an income plan for half as much capital as a generalist.
Right.
You know,
And what just one second, James, what was the catalyst for this topic today, and exactly what James Andy was talking about was there. I was introduced to a couple people. I work with a guy down in Florida named Rob Zebart, who does a lot of reverse mortgages. And Rob and I went to the same Circle of Wealth Master Mentor program. So we philosophically kind of come from the same thing, although he's in the mortgage business. So what Rob was he's able to identify problems that people are having that come to him for the reverse mortgage. And so he brought me in on a couple cases. And both these people were working with advisors. And when I was looking at their portfolios, they were doing a fairly decent job. But where the advisor failed miserably was that they didn't run the numbers, they didn't do any planning. And both these people were pulling way too much money out of their retirement accounts. And it was very clear that they were going to run out of money. And so, just as you talked about, Andy, I mean, it wasn't the client's fault, because most of the advisors out there are generalists and they aren't necessarily trained to do retirement income planning. So what I ultimately did was I took them through my process, and we ultimately got them kind of set up where, we rearranged some things, and we got it so they actually were going to be fine in terms of they weren't going to run out of money. But I came in, after the fact on kind of doing that. And I'm sorry, I didn't mean to cut you off, James. I thought you were going to kind of say something.
No, totally good. I was just going to reiterate that it's interesting. In one of our last episodes, we talked about how the misconception out there is that an advisor is an advisor is an advisor. It's kind of like saying that a general practitioner doctor is the same as a neurosurgeon, is the same as a heart surgeon, and they're not the same. But oftentimes the mistake that retirees make is they just find whatever advisor, and what they end up finding is that, well, they've spent the last 40 years accumulating wealth, but they haven't strategically planned on how to utilize that wealth and how to pull down from that and how to keep it lasting after they retire for the next 30, 40 years or however long that they live after they retire. And having a specialist can really help you focus on that. So let's dig into that. Let's dig into some of the types of advisors. People need to know what types of advisors there are and why that's important for them.
Great thing. So in preparation for this episode, I just went on Google. And I just looked up types of financial advisors, and we got a couple links up there you can see. But I found some neat articles with this site called NerdWallet. Bankrate.com had stuff. Forbes had stuff. But so there's some great articles. I would just encourage people to kind of Google things. But ultimately, when you break it down, well, I'll take a step back. So if let's say we go back in time 30 years, and let's say all of us want to get into the financial business. Okay, what's the process of doing that? Well, someone has to sponsor us, and then we have to look at different firms that we want to join. Well, what types of firms are there out there? And that's kind of where I was going to start right here. So there's the classic wirehouse, right? So that's your classic stockbroker firm, and the wirehouses that they got their name like a century ago, where the brokerage firm actually had branch offices connected with their main office by private system, telephone, telegraph, or actual hard wires. And so those are your stockbrokers, and they're kind of connected to the exchanges, and they actually sold securities and they manage money. Now, they founded, they were started many years ago, but they've kind of evolved to do more wide range of financial services. So these wirehouses will do financial planning. They'll do retirement planning, investments, and real estate advice. But when you work with the wirehouses, most of those recommendations are going to be very investment focused. I'm not saying that they don't talk about insurance at all, but they're very, very investment focused, which may be fine. But, and again, you always look at, well, how are these advisors compensated? Well, the primary compensation is through advisory fees for their money management. And some examples of the wirehouses could be a Morgan Stanley, a UBS, Bank for America / Merrill Lynch, as well Fargo's JP Morgan. So these are big names that everybody's heard of before, and they've got a lot of name credibility. Then there's also what I call full service retirement services. And like when I got started in the business back in the late 1990s, I started off with a company called Lincoln Financial Advisors. And at Lincoln, they provided, planning services and these again, we could sell investments, we could sell insurance. And many of these companies started off as insurance companies, but they also evolved to providing investments and financial planning services as well. So when I was at Lincoln, I could sell any product that I want to, any kind of money manager, but I had a financial incentive to sell Lincoln Insurance. And, many, many years ago, I was also recruited by New York Life. Great company, but I went into the literature room and all I saw was New York Life products. So a lot of these companies, they provide comprehensive services, but they give their advisors, financial compensation to sell their products. Some of those examples would be, Lincoln, New York Life, MetLife, Northwestern Mutual, Guardian, Transamerica, Prudential, those sorts of things. Andy, did you have any thoughts or comments on your full service financial services?
Yeah, I think, from my experience, how you approach planning is really a philosophical thing, right? So you have advisors that reside in various firms. As you said, a lot of the firms are going to have a particular focus, whether it's they have proprietary products that they're favoring over other products, or they're more, as you said, growth focused rather than income focused. At the end of the day, if you're going to be a specialist and you're going to focus on retirement income as your specialty, then it's really about being philosophically aligned with your clients, right? You can't ignore something like Social Security and hold yourself out as a retirement income specialist. So somebody like you, for example, you're a retirement income specialist because you embrace all of the tools in the retirement income planning toolbox. And the other thing I would say, as you were talking about the different firms, the terminology that you used was what you had available to sell. And I know the advisors that we work most closely with, Jim, like you, it's really not about selling anything. It's about building a plan, and all the pieces and parts come together and work in a way that allows the plan to come together and be delivered effectively over time. So I agree. I think the fundamental difference is philosophical. It's, are you a salesperson? Are you a planner? Are you a generalist? Are you a specialist? And if you are a specialist, what kind of specialist are you? So for you, you're a retirement income specialist who obviously focuses on client first. That's the fundamental difference between someone like you and 90% of the other advisors that I meet throughout my work, who just really aren't ready to be specialists. They'd rather be a generalist. But at the end of the day, clients who are at the phase of income or at the income phase, they need a specialist to make it work.
Yeah, agreed. And just to kind of move on to the different types of firms. So you've got what I call the insurance-based firms that kind of started off that and kind of evolved into planning, but you also have a lot of independent financial advisory firms. And so I left Lincoln in the early 2000s and joined an independent broker-dealer called LPL, which is still around. And I just found that with being independent, which means that you have no financial incentive to sell any particular product. And we, both Lincoln and where I used to be and these other independent firms, we still have the flexibility to kind of run our own businesses. But I just found there's just, I think you're right, Andy. I think there's a cultural thing with being completely independent. And I think that's a selling point, because I think everybody in the back of their mind is saying, what is this guy trying to pitch me? What's the sell? What's he trying to pitch me? And so I think when you're dealing with an independent advisor like myself, we don't have that financial that kind of incentives. And so just to kind of give you, when you're doing your when you're doing your research in terms of independent advisors and those kinds of firms, I'm with Regal Investment Advisors, which is a smaller RIA, but fantastic company. LPL, Commonwealth, Raymond James, Ameriprise, Equitable. Those are some of the other big names kind of in this independent financial services space. And then the last kind of segment I look at are the big custodians. And those could be Charles Schwab, Vanguard, Fidelity, T. Rowe, where these firms kind of cater towards the do-it-yourselfer. Says, I don't need an advisor to manage my money. I'm going to buy whatever I want in index funds or so forth. But these big custodians are also providing financial planning services. And the difference between someone who works at Vanguard or Schwab is that they're typically W-2 employees. They're hired by those companies to provide planning services. But when you look at the recommendation, they're always redirecting the clients to that company's investments. So if I work at Vanguard, by the way, Vanguard's a great company. I love their stuff. But if you're working with a Vanguard, advisor, I bet you $1 that you're going to be in a Vanguard portfolio, which isn't necessarily bad. But again, their job is to kind of sell their products. And so and as you've said many times on just today, Andy, is that they are going to give you an overall retirement picture. Oh, I think you're going to be okay. Let's just go into a 60-40 portfolio and take a little bit of money out and you're going to be fine. When you and I know, Andy, that's absolutely not the case when it comes down to retirement income planning. And so those are the four different types of firms that I've kind of seen out there. So when you're out there researching different types of firms, I'm just trying to give you a quick bullet point on what your options are. And the other thing is that can
I interject,
yeah,
Jim, real quick, just on that
absolutely.
topic, because I think it really is an important point to make. A lot of these firms that you're talking about that as a do-it-yourselfer you can go directly to, most people engage them during the accumulation phase, and the sole focus is really the cost, right? So they believe that at the end of the day, they're better off at a Vanguard or a Schwab or something like that because they're going to pay less in cost, and ultimately the overall performance is going to be comparable. So net, they end up in a better place. And I would say, okay, I could potentially be convinced of that occasionally, but where the real separation happens is once you transition from accumulation to income. There are unique challenges, as you well know, that people who convert from accumulation to income face that they never face prior to turning on that income. And fees, while they're a part of the equation, they become a much smaller part of the equation when you're dealing with the issues that you and I both know, not the least of which is the threat of dollar cost ravaging, which is inevitably what happens if you focus exclusively on applying a growth strategy to delivering income. So I just want to make that point that I think people start a relationship based upon fee alone, but then in the end, they're not able to delineate between the value and the fee. And the value is so much more important when it comes time to delivering income.
You're absolutely right. Because again, my bread and butter is doing Social Security seminars. And again, I'm here in the DC area, and I've got, quite frankly, a lot of high net worth people who come to these workshops. And so very frequently, I'll see people with anywhere between, $3 and $10 million in their portfolios, and they've done a pretty good job in the accumulation. But you finally get to a point when you're trying to make that transition from accumulation to distribution, where things get complicated. It's not about a target date fund or an index fund. It's distribution strategies. It's how to minimize taxes. It's how to pay for long-term care. It's legacy planning. And taxes are a big one. And we're going to be doing some topics on taxes in the near future. But yeah, that's a really important point. So what I was going to talk about just a little bit were the different types of advisors, who are out there. Again, so when you're actually talking to advisors, you just need to understand what's out there and the different types. So there's a thing called a robo-advisor, which is, I guess, has been around, I don't know, maybe a decade or so. And the robo-advisors are kind of computer algorithms, and they're really kind of designed for the person that's kind of younger, maybe in their 20s or 30s, maybe the 40s, who you're just kind of starting off in life, kind of just starting with their portfolio, and they don't really need much advice at this point. It's about, hey, how should I have my money managed? and you're in the accumulation phase. So there's not that much planning involved, and so that's kind of where the robo advisor is. But I would just be honest with you, what I've seen, if you actually look at the performance of a robo advisor versus, let's say, a target date fund at Fidelity or Vanguard or BlackRock or any of these companies, you're going to see that the performance is very comparable. So, I mean, if you're the choice between a robo advisor, unless they're providing some other services, I mean, quite frankly, I think you're probably better off in an index fund or asset allocation fund at Vanguard or Schwab or Fidelity or something like that. So that's sort of the sort of the entry level type of advisor. There's also the financial salesperson that we just talked about, that they kind of work for a Vanguard or Schwab or Fidelity, that in their job is ultimately to sell the products of that firm. And again, I have no problem with Vanguard's mutual funds and ETFs or Schwab's or Fidelity. They all have great products. The question is that you just need to understand who you're working with and what their job is at those firms. Okay. The other thing is that there's also portfolio managers. So my wife's father created a wealth advisory firm in Pittsburgh called Cooks and Pierce, and he was the actual money manager. He placed the trades, he did the research, and so you actually have portfolio managers, and that's what their focus is. A lot of the wirehouse advisors, and they do a really good job. Again, these are the UBSs, the Morgan Stanleys, the Merrill Lynches. Those guys, there's some really good money managers with those. But again, their primary focus is money management, which is great, as you said, Andy, in the accumulation phase. So that's a third type of advisor. Another type of advisor is what we call your financial planners that have a designation, a CFP, which is a certified financial planner. You could be a CHFC, which is a chartered financial consultant. I'm a CRPC, which is a chartered retirement planning counselor. There's also a RICP, which is the retirement income certified professional. So there are advisors who have designations that say, hey, I've been to a certain level of training in these certain areas. And so ideally, and we're going to kind of talk about what questions to ask, what you need to know about advisors in our next podcast. But, having a designation and having those credentials, I think, are really important. And the other thing, too, is if you are a CFP, you are kind of held to a higher standard and a fiduciary standard, which we're also going to talk about in the next couple of episodes as well. And finally, you have your wealth advisor or manager. And in these types of advisors provide really a holistic advice to high net worth individuals on a broad range of financial topics. It could be all sorts of things: financial planning, estate planning, tax planning, retirement planning. And again, they take a wider holistic approach to planning. So those are the different types of advisors, who are out there. And I'm not sure, Ian, if you have any other kind of final thoughts on that, but
Well, I mean, I would say, Jim, what you just went through, I think is worthwhile, in that people understand the approach that different people have, their focus. At the end of the day, whether or not they're generalists or specialists is still an open-ended question, right? So I could fit into any one of those categories and still be a generalist, not a specialist. So a designation, a title does not necessarily mean that I'm a specialist. And from my perspective, and I know you're going to talk more about this, but this is what I harp on all the time. I focus on retirement income every day. I know it's the focus of your practice. If you're looking for somebody to help you with retirement income, it's really important that you find a specialist, just like it is with any physical health issues that you find a specialist. It's the same thing here. There are all kinds of educated people with designations who can tell a great story about how they run their business. But at the end of the day, whether or not that's a fit for you comes down to what do you need. And if you need retirement income, then you need an income specialist.
right. And as I kind of was talking about, I'm sorry, what was that, James?
Oh, so I was going to say, sitting here listening to you guys talk, it's kind of reminding me of the movie Alice in Wonderland, where Alice is walking down the road, comes to that fork in the road, and she asks the Cheshire cat, "Where should I go?" And the Cheshire says, "Well, depends. Where are you trying to go?" She goes, "I don't know." And he goes, "Well, then what road does it matter? Take either one, you'll get there." And it's interesting that a lot of people kind of treat unknowingly. I don't think it's the average retiree's fault, because they don't have that sort of education, but unknowingly they bundle advisors into the same pool and assume that every advisor can and will do the same thing for them, when in reality what they should be asking is, what is it now that I'm trying to do? If I'm 25, 30, 35, 40, whatever years old, and I'm trying to accumulate, then the strategies and maybe the advisors that you'll talk to would be different than the ones that when you're now approaching retirement. And ideally, you're starting to ask some of these questions prior to retirement so that you can make sure that you sit down with the right specialist, the right advisor, to help you now transition from the growth phase or that accumulation phase to now, all right, now I've accumulated my wealth and I now need to use it. And I need to use it strategically so that I don't pay too much in taxes, so that I don't deplete my resources because of a market crash, so that I can live longer and provide for long-term care and all these different things, which is actually what we'll cover in our next episode, is some of the questions. Once you've kind of had an idea of now the direction that you're trying to go, our next episode will be about some of these questions that you should ask to your financial advisor and help provide some of that clarity to you as you're trying to make that transition.
Yeah, it's really, and again, that you laid that up great, James. Is that in our next episode, we're going to talk about really actually what you really need to know about the advisor who you're going to be working with. I mean, there's all sorts of questions, but Andy and I were kind of talking about this ahead of time. It's really like, what do you really need to know about the advisor who you're working with? And so that was a perfect tee up. So, well, anyway, guys, I hope you think this was a worthwhile, podcast and topics, and Andy, thanks for being on here. And again, as James mentioned, our next episode, we're going to be talking about different questions you can ask and also what you need to know about, advisors, before you hire them. So, anyway, James, I think I hear that music that's calling us out. So, anyway, so I guess we'll see you on the next episode of Retirement Insights with Jim Musgrave.
Awesome. All right, you guys, we'll see you on the next episode.